me share a performance story with you. 2018, the trader that I'm going to feature today, minus 4% on the year. 2019, minus 21% on the year. 2020, this trader was up 18% for the year. 2021, this trader was up 32% on the year. 2022, this trader was up 89% on the year. In 2023, this trader was up 51% on the year. In 2024, this trader is up after March, after only 3 months, is up 124% on the year. His February 2024 performance was 45.4%. His March 2024 performance was 51.08%. Again, he is up 124.55% on the year so far, 2024. Where is this performance from? From the softs. What are the softs? Cocoa, gold. Also from stock indices. Go look at charts. Gold's to the moon. Cocoa is to the moon. Indices, the first 3 months, have done very well. This is what happens when you're a trend-following trader. You capture big moves. Did this trader know that cocoa was going to go on a earth-shattering record run-up? No. Nobody can know that. But he had a system, a basic system, with rock-solid discipline, and he stuck to his guns. It's an inspiring story. Now, this trader has been featured in my books, going back to the Little Book of Trading, and most recently in my Trend Following book. He shared a great story about how he made 45% in October 2008 in my Trend Following book. Now, when you hear that a trader is up 124% on the year after 3 months, when you hear that he's done 45% and 51% in back-to-back months, I don't know what you're thinking or what you're feeling, but things like this don't continue on in perpetuity. I mean, it could, but not likely. This is trend following. What you take away from these types of numbers, this type of performance, is the opportunistic aspect of trend following. The I don't know what's going to happen, but I'm ready for it when it does happen attitude. Let me reach back and play an interview with this trader, the trader who produced the numbers that I just read off to you. He appeared on my podcast for the first time just about a year ago. And I think given his performance so far in 2024, it's worth the repeat. Because I'm not sure anybody else is doing those kinds of numbers. Now, let me add a caveat here. Why are not all big trend-following funds doing the same kinds of numbers? A lot of big funds have billions under management. The trader that I'm talking about does not have billions under management. He has a lot, but not billions. To get billions under management, you often have to make sacrifices. You have to give the people what they want. And the people are often afraid of high returns. But if you're like the trader that I'm going to replay today, if you have clients that are aligned with you, then you just say, what the fuck? Let's play the system out and let's let it run and let's see what happens. Let's goose it. Let's go for it. Full throttle. And that is inspiring because that is trend following. He's not necessarily original. We've seen huge performance in the historical record. Ed Seykota, John Henry, Bill Dunn. But for today, Paul Mulvaney, he is winning big time. I hope you enjoy this replay. I first interviewed my guest today in 2005. We actually had a little bit of a debate about when this first interview took place. He was featured in my book, The Little Book of Trading, which was a nice compact book about trend following. Since I have launched this podcast, I've been chasing my guest today. Well, not really chasing. I would occasionally ask him, and he would say, nah, I'm too busy doing what I'm doing. Actually, he didn't tell me that he was too busy doing what he was doing. That's me just talking. But he always politely declined. My guest today had a great year in 2022. He made 90%. Folks, most of the world did not make 90% in 2022 as a trend-following trader. No great buildup, no further delay. Let's jump right into my conversation today with Paul Mulvaney of Mulvaney Capital. And just be forewarned, you're going to notice something with Paul. He is a no BS kind of guy. I almost want to say Joe Friday from the old Dragnet show. Very curt responses. Now, you can't see this on this episode, but we actually did video for this, often with a smile on his face. Look, when it comes to trend following, it is what it is. Paul doesn't beat around the bush. I hope you enjoyed this conversation with Paul Mulvaney. I got to tell you, you are how do I want to say this? The hardest trend following man on the planet to reach, with one of the most interesting track records. A tough guy to chase down. I've been chasing Paul Mulvaney here and there for a long time. I think you like it that way.
I'm just not very inclined to say a lot in public because there's a lot of people already saying too much in public about the markets. I'm a trader, I'm not a commentator.
Well, that kind of defines it right there, doesn't it? You're a trader, not a commentator. And in a way, when you say that, you're pretty much telling people how the world really works, at least from your perspective. The commentating doesn't play a role at all.
No, definitely not. It's important to remain detached from what's happening in the markets, not be drawn into the social contagion and the herding behavior.
I mean, you're not mysterious in the sense that everyone can see your track record. They kind of know what you've been up to, at least in terms of performance. There is a feeling, and given that I met you a very long time ago for the first time, there's a feeling that you do try to keep, I'm assuming for assorted reasons, you do try to keep the world at bay. Is that a fair assessment, that you try to keep the world at bay in the sense that a lot of what's going on in the regular world doesn't really play a role with you in your trading?
The system is purely rules-based. The only inputs to the system per se are price feeds. There's absolutely no debate or discussion or analysis of the fundamentals. None of that impacts the trades that we take. Absolutely everything we do is based on a set of rules derived from historical simulations on as much futures data as we could lay our hands on.
I get the impression from you that you'd be very comfortable if that was the sum total of the interview. I wish people could see your face right now. What's so interesting, even for me, who's someone who's been in this industry for a long time, I know there's other people out there, peers of yours, and even people that came before you, that really, really love your bluntness. They love your lack of words. They love that you stick to your guns.
That's good. I'm glad somebody loves something about what we do.
Somebody recently, they were talking about your performance, their immediate thought, with probably really not understanding what you do. They said, well, even though he did really well in 2022, the preceding bunch of years were not that good. Therefore, he just got lucky in 2022. My perspective would be, well, in many ways, trend following performance is always going to be a little bit of luck in the sense that you don't know when it's going to happen exactly. Why don't you try to explain to the person that really wants to learn out there, and this is a really big question, why a track record like yours that's been assembled over 2 decades can look like it does. People just have this natural human tendency for consistency. So I think when they see your track record, the consistency filter in their mind just blows up. They can't wrap their arms around it.
To start with, this business is a marathon, not a sprint. Big trends, the sorts of trends that we try to exploit, which may run on for years, don't come along all the time. Big part of it is just patiently waiting until the major trends emerge. How many turns in the interest rate cycle of the magnitude we've seen in the last 18 months is anyone going to see in a career? Not that many. We had to spend the period from around 2015 to 2019 waiting for trends to emerge, and eventually they did.
Let me take you back in time, because for the way that you're talking, the way that your track record has unfolded, you have a certain amount of confidence in what you're doing. Give me the first moment. I have an idea of where this question might go, but the audience might be new. Give me an idea of how you started, your light bulb moment that led you down the path to where you could be giving me the answers that you're giving me right now, which are just Joe Friday, no nonsense, just the facts. Where did this come from? How did it start?
Well, in the 1990s, I read about the trend followers who were active at the time. That sparked interest. And then I started researching futures data. That's the key point, really, creating realistic simulations and avoiding all the pitfalls of designing simulations. I did put an awful lot of effort into cleaning historical data, all that side of it, that people probably outside the industry completely underestimate. It's very difficult to find raw, clean data. A lot of focus has to go into that. And then there are a series of methodologies that can be applied to creating realistic simulations, and that's what I did. When I finished the research, I was able to convince myself that the work that I'd done was realistic. Even though there was no guarantee of what might happen in the future, at least I had an accurate idea of how my rules would have performed in the past. And I just moved on with that sort of underpinning my confidence.
If I keep you in a moment for a young Paul, you mentioned just generally seeing other performance, seeing other names that were doing something similar. Was that enough for you just to jump in? Was there any mentor in play or any guidance, or is this just the software developer, programmer guy hearing about it, jumping in? This meshes with my personality. This meshes with how I see things. I'm going to give this a try.
The key point is that other people were already producing returns in trend following. So at least I knew it could be done. That makes a huge, huge difference. I wasn't searching for something that might not have been there to discover. In fact, I wasn't discovering anything new. I was just producing my own recipe to capture returns in the way that other traders already were. That's really very, very important. If there'd been no solid evidence that trend following worked as a strategy, then it would have been a lot more difficult to maintain focus in the research phase. Then beyond that, I mean, academically, I had a quantitative background. So when it came down to actually looking at numbers, looking at historical time series and analyzing them and writing codes to analyze them, I had that training. And I suppose when I started reading about other trend followers, I instantly thought, well, I should have a look at that. Maybe I could do that as well, and took it from there.
Taking it from there, the way that you have, and I think it's a fair description to say that you have a trend following style that's about absolute returns. As far as I can tell, you can correct me if I'm wrong. Give me some observation or some feedback on the idea of developing a trend following approach for absolute returns, especially contrasted against many in the industry in the last 20 years that were attempting to perhaps capture a piece of this trend following return, but maybe change the risk profile or squeeze it into some kind of mold that didn't look like absolute returns. Speak to me about the idea of absolute returns from your perspective and why you chose that. Maybe contrast the pros and cons compared to maybe other firms that were not really going for absolute returns, even if they called themselves trend following traders.
Going back to day one, when I started researching the system in the 1990s, I'm not sure if I really understood enough of the factors I'd have to balance to do anything other than just go for high absolute returns. When I started writing the simulations, I tweaked the rules to try to produce returns, but the only risk or volatility measure I looked at was the maximum cumulative drawdown. I didn't bother with any other sort of volatility measure. The questions attributing more understanding to me than I had in the 1990s, I just started with a very simplistic objective to design a system that could generate 20% per annum in trading profits. I didn't pay a lot of attention to the volatility side of the equation.
Back at that simulation period, when you're just kind of investigating things, jumping in and working in the trend following kitchen, so to speak, to make your souffle, what type of max drawdowns were you thinking were possible at that moment in time that you were willing to live with?
Categorically, the biggest drawdown that's feasible is 100%. I mean, it's possible to lose all the capital with any strategy. Nobody should be deluded about that. We have to approach trading with that in mind. I didn't have a preconceived idea around the size of drawdowns I'd be willing to live with. Clearly, from the work that I did, in excess of 20% was pretty much guaranteed to happen, given the sort of leverage that I was using in the program. And ultimately, after I started trading, that blew out in practice to a couple of occasions when we drew down 45% roughly. Would it be psychologically a lot more difficult on a 50+% drawdown? I suppose it would. That's a big psychological barrier, but it hasn't happened in this program to date. But if we keep trading the system for long enough, one day it will. It's important to bear in mind is that when we look at simulations, not my trading simulations, but simulations of abstract games with very, very favorable win-loss ratios and percentage of wins, that type of analysis. So we might postulate a fantastic system that has an average winner that's 10 times the average loser, and it makes money on 70% of its trades, something absolutely ridiculously good like that. Simulate that for long enough, and one day it will have a 90% drawdown, and yet it will recover from the 90% drawdown to eventually deliver those high returns that we're looking for. So that's very important. Then what can actually happen even with a very, very good system is much worse than people are willing to contemplate. So drawing down 90% doesn't tell you that the system's broken. No, because there are theoretical systems with much better risk-reward ratios than any currently active CTA program has demonstrated. And in simulations, they almost blow up.
Let me get you to talk about yourself for a second, if you will. Pretend to be the person analyzing Paul. What do you think it is about your personality that has done so well with your strategy? Is there something inherent in you personality, perspective that worked so well when you came into this style of trading? Or is it something you've learned? Speak to me about you and the you part of running your strategy.
I think originally it was fairly unemotional. It was just a case of doing the research rigorously. When I started showing the simulated performance to potential investors, people did say it's too volatile to be commercially viable. But I plowed on anyway, stuck to the same system. What we trade today is a system that hasn't changed since 2005 in terms of the long-term trend following components. And over time, as I watched the system, I think I gained a better understanding of why it worked, how important it was not to place unreasonable expectations on the system. Big drawdowns would come unavoidably, but that was all within the bounds of what I knew could happen and had happened in the past, and I stuck with it. I'm not sure if that's really answering your question, but I think the kernel of the answer really, it's about rigorous research and ensuring that emotions are completely eliminated from the trading process.
Do you do anything different or special in your life or your lifestyle that enables you to keep this singular focus that you have? Or are you just a normal guy and this is what you've chosen to do for your profession? Everything else is just kind of a normal lifestyle.
I think I'm very, very routine oriented, a creature of habit, and I'm happy to just keep doing the same thing again and again and again. That's really what the system's about.
As a kid, did you enjoy the routine?
Not sure. That's a difficult question.
I'm good at this, man. 1,000 episodes, you avoided me. I've been practicing for 10 years to get to you.
I was interested in numbers from an early age. Geometrical and numerical structures was something that drew my attention. I'm not really sure where the routine kicked in, but at some point it did. So to keep running the system for thousands of days without really getting bored with it, I think that was important, but I have no idea why it played out that way.
Let me shift you into something that I think for people that know about your work, and especially for me, stands out. And of course, you can see this in other trend following track records, but it's terribly interesting that since, let's say, the implosion of the dot-com bubble, it's terribly interesting that there's this UK trader named Paul Mulvaney running a company called Mulvaney Capital that seems to have magically figured out 2008, 2022, when so much of the rest of the world did not. And of course, we both know a lot of it goes to the system. You didn't make a prediction. You didn't make a fundamental call. That's not what you do. It's terribly interesting that this has happened. Do you think about that in the sense that you can't help but see a newspaper or hear a news program here or there, or somebody talking that for two of the most eventful years in our lifetimes, your trading approach got it right? That's a pretty cool achievement in my book.
I think you're overstating the uniqueness of it. It wasn't by any means unique. Lots and lots of trend followers made big money in 2008 and 2022.
Maybe they didn't make on the same scale as you? Is that a fair assessment?
We need to look at the league tables. We were probably quite near the top of the table both of those years. The fact is, we're using generically similar techniques to dozens of other people who also make big money. From my perspective, I don't see it the way you're describing it at all. There's nothing magic about 2008 or 2022. We just applied common sense techniques that had been developed by researching historical data. The techniques appear to work because other participants in the market are subject to biases, And in both of the years that you mentioned, the chickens came home to roost. There were major fundamental developments that drove markets, and trend following systems were able to capture major returns. There's nothing magic about it. Anyone who put in the work could have done the same thing. Many did.
If I keep it to this idea of these two particular years, as you mentioned, of course, I've seen many track records, and yes, other people did very well in 2008 and 2022. But when you were first doing your simulations, were you thinking about these trend following approaches from just an absolute return standpoint and what they could do over time? Or were you thinking about when these types of moments or years or months happen in the future, when those that have the biases have their particular fundamental strategies, when those things go south or sideways, that your approach that you were doing simulations on would have the chance to perhaps do well during those periods? Was that part of your thinking? Or was it just, hey, I'm shooting for absolute returns? You weren't really analyzing when those absolute returns might happen in terms of the curiosity question that I'm pointing out about these two particular years?
Well, if we look at the basket of markets that we trade, there have been big trends at some point in the last 24 years, and absolutely all of them. There's no single market that hasn't produced a big trend at some point over that period. In fact, it was a similar story over the previous quarter century, which constituted the original simulation. It's more a case of knowing from historical analysis that even if there are long periods when not very much happens, eventually, historically, trends have always kicked in. Then just being patient enough to wait for that to play out. Before I started trading the system, I worked as an options trader. I was colored by that experience in terms of realizing that the tails of the distributions were fat, but I might have to wait a while before a really fat tail came along. So that's how I look at trend following. The major trends are few in number, but can be huge, unlimited in magnitude. They just don't come along very frequently.
Do you love this game?
Yes, definitely. Yeah, it's fascinating.
Building on that, assuming good health, assuming you still love, could you imagine any reason other than perhaps that 100% drawdown that you spoke of, any reason why you would stop?
No, definitely not. I'm able to continue going.
That's the strongest I've got you in this conversation so far. I mean, it's tough to pull it out of you, but man, I got it. No way am I stopping.
No, I intend to continue trading for as long as I'm able to trade.
Why do you love it so much?
Ooh.
Oh, good one.
Well, we're constantly looking at what's happening in the real world, seeing that play out through market prices. I suppose for me individually, I turned out to have a skill set that was applicable to qualitative trading. These are all very interesting questions, but they're not things that I've necessarily thought about a lot. I do what I do, but I haven't necessarily analyzed why I do it, what drives me.
That's why they pay me the big bucks, to ask the questions you've not thought about.
Yeah.
You must get a lot of requests, though. I mean, I'm sure people have wanted to talk to you a lot over the years, so I appreciate you giving me some time to chat. I think when people are listening, or if they could see, there's a lot to be learned in just watching your mannerisms and watching how you answer questions. Hey, Mike, you already know this. It's just the system, damn it.
I think that's just the way it is. Yeah. A big part of my philosophy was driven by the work of various authors in the field, including yourself. You indoctrinated me.
I don't know about that. Well, I guess I probably had a website up starting 96, 97, but you were already looking at things then too, though. I find what you do and your personality, you remind me a lot of somebody I'm about to say. I met him several times. You remind me a lot of Bill Dunn. Bill carried himself in a very similar way. And in my opinion, it was just the facts. This is what I do. There wasn't a lot of fluff, so to speak.
Bill Dunn was one of the first CTAs I read about. And if there ever really was a single moment that inspired me to start the research, it was reading a Market magazine article in the mid-90s about Bill Dunn.
For me, I guess it was probably the Turtle story and Bill Dunn, perhaps John Henry. Those types of stories were also, for me, the influence. It's a fascinating world to be involved with in some capacity.
Yes.
Let me keep you at the idea of being a fund manager, having a track record that now is exceeding 2 decades. People will see the good years and perhaps the phone rings more. And maybe if they see the bad years, the phone doesn't ring as much. Speak to me about how you have been able to manage outside pressures. Because even though you can be very blunt and very straightforward about what you do, you know that the managed money industry, especially the sales side, it's often about excitement, getting people worked up. That's not your track record. That's not your personality. But of course, people are going to have an interest in you over time. Have you had to manage that particular issue in any way to stay grounded and stay, frankly, Paul?
I think short-termism is one of the main pitfalls around trading and investment. This system isn't short-term, it's extremely long-term. As I said before, I see it as a marathon, not a sprint. What that means is that often there are exciting things happening that don't necessarily impact our program. Investors may look somewhere else. That's just the fact of life. We have to live with that and then hope that eventually the longevity of the track record will carry weight. But yeah, I mean, dressing up a product for commercial reasons is probably going to lead away from a rigorously optimal trading strategy, a lot shorter term, with probably too much emphasis on keeping the volatility down and keeping the drawdowns under control.
How do you manage the issue of change in your approach? We can call them critics. Perhaps some outside critics might say, and this gives you the full chance to respond to why those critics are wrong. Some outside critics might say, well, gosh, okay, great. You've got this approach. You did all this research. You've got this track record. You don't make a lot of adjustments, if any. How do you know it's going to keep working?
You don't. You don't. There could be a major event next week that puts us out of business.
The follow-up question, and maybe put some math to it if you want. Your expectations are for that not to happen. There's always a percentage chance it could happen, but your expectations are not for that to happen. I mean, look, we could have the dinosaur blast again. That's going to do a lot more than take out Mulvaney Capital. That's going to take out me and Saigon. It's going to take us all out. There's all kinds of stuff that could happen. But I don't think that's your expectation, that you are taking risks right now in terms of your trading approach, that you're taking risks that are out of line based on how you understand your approach. Can you clarify that a little bit more? Things don't have to continue, but can you put a little more flesh on those bones?
Well, theoretically, we could get a move in a single market tomorrow that would break the fund. The way I look at it is if we start to get really severe changes in markets, then the system will be competing against people more widely in the markets who are not using any rigorous techniques and are going to make all sorts of off-the-hip decisions during crises. I'm not sure if I'm really explaining it very well, but ultimately, I suppose I feel reasonably confident that when that starts, the system will be able to latch on to developments and then claw back the money it loses at the beginning of the onset of a crisis.
Over time, your modifications, if any, your changes, if any, have been minimal. Did your homework, did your research, did your simulations, started your trading, stick to your knitting, stick to your guns. That's been your approach.
Yeah, very few parameters. That's important. So people talk about markets changing. Of course, they evolve and they change. But I think somebody who suggested that we should be modifying our system probably underestimates how few parameters and how simple it is to start with. When we boil down market activity to very, very few parameters, then that doesn't change. But the market's full of changing enough in the medium term to undermine a system with too many bells and whistles. It's a big part of the philosophy.
I know the answer to this question because I know your track record. I have a sense of you. You don't spend time comparing yourself to other people, your firm to other people. I don't see that in anything you do, that you appear concerned about what another firm is doing or what the industry is doing. You seem to have developed a loyal stable of clients who like what you do. Again, you stick to your knitting. Fair description?
I think that's true, yeah. We have to be detached. We don't want to be looking over our shoulders at what other people are doing. That's not the road to riches in this business.
Do you even allow yourself to engage? What kind of filtering system? I mean, look, gosh, since you started your firm right there during the .com era. Then we've got phones, it's information all the time. And I know it doesn't play a role in your trading approach. I understand that. Has there been any modifications in how you run your life with the ever increasing information flow to keep distractions away?
I do. I feel information overload for sure. Very thankful I'm running a system so the information overload doesn't permeate the trading. Yeah, I find email a nightmare. I increasingly find journalism a nightmare. Basically, what's happened is over the last generation, there's been a proliferation of low-quality journalism, opinions rather than facts or news. Not all opinions are born equal. The problem is there's just so much material being churned out. To get to the good stuff, we have to navigate an awful lot of material that's maybe not so useful. That's all a challenge for sure. Just dealing with email is something I find very difficult. Sitting in front of news feeds, which I do, and trying to devote time to reading the valuable stuff, that's a challenge. Television news, I've gone through various cycles, watching different sorts of news programs, and eventually reached a saturation point with each of them and then gave it up.
The idea that a younger Paul, 25 years ago, had developed and latched onto something that now even the older Paul, perhaps, I'm assuming, appreciates a lot more. That this world came into your purview and you could go down this path. Quite interesting to see a significant portion of your lifetime to be immersed in this, and that you made a decision a long time ago that was a correct decision, as far as I can tell.
Well, I suppose after I got started, it developed positively enough. It was feasible for me to continue, so I just continued doing it. Working in my own small firm gave me a lot of flexibility. Even though I was very process-oriented, I was able to just keep doing what I wanted to do, patiently waiting for the returns to emerge.
Let's see, I'm looking at the years here. I'm guessing 2015, 16, 17, 18, 19. Did you feel like in that period of time, that 5-year window, did that period of time try on you more than other periods of time? Or were you able to stay the same person, do you think?
I don't think it made a difference psychologically, because by 2015, the system and I had been through various cycles. The original simulations traded through various cycles. I was well aware there could be very lengthy fallow periods. There had been in the past. There would be again. The onset of the great financial crisis in 2007, a violent drawdown was psychologically more difficult to deal with than that meandering sideways period that we went through. And the 15 to 19 period was punctuated by some big gains on events, even though at other times we lost money. There was always the sense that something big could happen. And sometimes over that period it did, only for the markets to fall back again. But then eventually COVID came along, a major regime change.
You were kind enough back in the day on one of my editions for my book Trend Following to share with me the fall of 2008 as it unfolded from your trading perspective. And I always thought that was a terribly interesting story that you shared, trading the style that you did and the length that you did and how things unfolded. To this day, I will still hear people, and I think there was a commentator named Ben Stein who famously said it. He said that if you made money in October 2008, you were doing something wrong. You and I understand this particular industry. We understand other players in this industry. But the vast majority of people, even people on so-called Wall Street, do not realize, except for perhaps some of the investment banks that had information or this or that, but most people don't think that there were people that were profiting in October 2008. They don't think that was possible. They don't think it happened.
Well, I mean, it sounds as if that's the perspective of somebody who would only ever buy stocks. Is the main reason we made money in October 2008 is because stock markets collapsed.
Let me frame a question this way. There's plenty of young people out there that want to observe success stories. They want to go in a similar path, just like you were at one point in time. At one point in time, you're like, hey, wow, that magazine article is really cool. Oh, that guy, Bill Dunn, seems interesting. I've got some coding skills. Let me give it a shake. Let me give it a try. This is not necessarily even a trading question, because you are an entrepreneur as well, in the sense that your business is an entrepreneurial business. What kind of insights would you share with young people that want to go down these types of, I'm going to go make it happen myself businesses, which is what you've done? What can you share, do you think, is important other than people observing you and knowing how you think and seeing your track record? Is there anything in particular you might want to share with young people from your perspective? You were just talking about the journalism and that's gone downhill and stuff like that. What might you share with young people in terms of getting started, going down a path that could be like your path in a way?
A generic entrepreneurial path. I don't know really. To answer that, I'd have to step back from it, analyze myself, what was important to me. What happened was I just got on and did it without really too much introspection, without really thinking about what was motivating me. That's a very difficult question. I did it. I followed a certain career path. I don't really feel like I've got a huge amount of guidance to offer to anybody else because I just haven't thought about it. I was in the midst of it, not observing it or analyzing it. About systematic trading in general, I started off in the 90s naively believing that if I developed a system that could generate 20% per annum in gross profits, then I would be able to raise assets very easily. That proved not to be the case. I would see the business development side of running a hedge fund as being a lot more difficult than the actual trading strategy.
You thought, hey, if I have 20% returns, people will come knocking, and you're saying that's not how it's turned out exactly.
That's it. I underestimated how important it would be to have the right people working on marketing in a hedge fund, and I wasn't that person. Asset raising is more fundamental than trading in a hedge fund.
At one point in time, if I look back to the history of this industry, perhaps in the 70s, I think there was a lot more of, hey, if the returns are the driver and people were attracted to the returns, maybe when the industry was smaller. I can understand your perspective in many ways. It is kind of unusual. You know Wall Street. Wall Street likes to whisper sweet nothings to people. And they can tell them about FTX. You could be rich overnight. You're competing with that kind of stuff, and that kind of stuff, those people will say anything.
Yeah.
The efficient market hypothesis is still something where the vast majority of investors, traders, etc., will at least give it lip service. If you were to give or try to give a way to understand why people should not give the efficient market hypothesis so much of their time and energy, how do you bring them into the perspective that you have?
The way I would look at it is that fundamentals change and market prices move. But the market prices definitely don't adjust instantaneously to changes in the fundamentals or the perceived fundamentals. Those changes happen gradually over time, and that's why we see trends in markets. The fact that the trend plays out gradually is a form of inefficiency that we can exploit. We get a chance to jump on the train as it's pulling out of the station.
You are in the heart of London still?
Yes, we're near to Bank Station, the heart of the city, yeah.
You mentioned it at some point in time, but if you can ever find your way out of the city to, I don't know if there's any direct flights to Saigon, perhaps.
Probably, yeah.
You've been to Asia, though, haven't you? Yeah.
Oh, yes, of course, yeah. The most likely places for me to go business-wise would be Hong Kong, Singapore, and Tokyo. If I do make another trip to the Far East, then I could easily stop over in Vietnam.
I would guess, because when I go into, there's a famous bookstore in Singapore on Orchard Road, Japanese bookstore, and every time I go in there, they've got my English books, at least 3 of my English books prominently displayed. Having been in Asia for a long time, I would say that Singapore, maybe I'm wrong, Singapore as a country, as a group of people, seem to be the most open group in Asia to trend following. Japan always translates my books first. There's clearly a desire there as well.
Well, they probably have critical mass in terms of translators.
Yeah, someone's buying the books.
Singapore, what would they translate them into?
Oh, it's just English in Singapore.
Yeah.
Yeah.
That's it.
But I find Singapore as a group, and I've given a bunch of presentations there over the years, as a group, Singapore seems to be in tune with the concept of trend following.
Yeah, well, I mean, it's a trading conscious society, isn't it? Around Boat Quay, you have those statues of traders, historical traders, people trading physical commodities in the 19th century, that type of thing. It's a crossroads, isn't it?
One day they'll have it, but they don't have it in Vietnam yet. Though, even though Vietnam is a huge rice exporter, they don't have rice futures here yet. It's basically small farmers, not large concerns yet. There's real price discovery issues they've not yet solved. I got to figure at some stage of the game, Vietnam will have rice futures as another market to potentially trade.
That'll be interesting.
Well, sir, listen, let me let you go. I've kept you long enough. I appreciate you coming on. People can find you and more about you and your company at Mulvaney Capital quite easy. Go check you out, see what you were up to there. I don't think they should expect anything but just the facts.
That's it.
I appreciate you coming on today.
No problem. Thanks for asking me.
I see a time when those awake will understand how to make money in up down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.